Today I'm going to look at Apple, AAPL. Apple is currently selling at $96.06. Market cap is a $530 billion company with a PE ratio of 10 and a dividend yield of approximately 2.17%. It also has 5.54 billion shares outstanding. As we know, Apple designs, manufactures, and markets mobile communication and media devices. The company's products and services include the iPhone, the iPad, the Mac, the iPod, Apple TV, and a portfolio of consumer and professional software applications, as well as the iOS and OS X operating systems. The cash flow numbers have been very impressive. We can see here that since 2011, the free cash flow production has been in the region of 30 billion, 41 billion, 44 billion, 49.9, 69.7, and the trailing 12 months is 62.7, or 62,778,000,000. In terms of capital expenditures, those two have risen slightly, but relatively low in proportion to the free cash flow. As indicated here, a capital expenditure of 12 billion with a free cash flow production of 62.7 billion. Now let's take a look at their efficiency ratios. I like to look at the net profit margin, and the net profit margin from 2006 onward, we're going from 10 to 14 up to 19 to 21, 26, 21, and the latest net profit margin is in the neighborhood of 22.87 right here, 22.87. So even if that drops back down to 2009 levels of 14, it would still be a fairly respectable net profit margin. Interest coverage ratio, ability to pay down the debt, is a good number, nice and high, which is, in this case, it's 83.77. And let's see what kind of financial leverage. Relatively low financial leverage ratio, 2.29. Let's see what else we can find out of here. Let's take a look at their growth. When we look at their growth over the last 3 years, there has been a slowdown from 37 to about 14 in revenue. In net income, this has caused a decrease in net revenue from the range of 38 down to 15 down to 8.56. And the earnings per share, 3-year average, also shows a slowdown from 37 to 17 to 13.49. This window here shows the current market price at $96.36, and the intrinsic value estimate at Value Pro seems a bit too high. So what we want to do is make this a more realistic number, and first say to ourselves, can Apple maintain a 14.5% growth rate with the increase in competition from Samsung and other smartphone providers? This is probably a bit too high, so I'm willing to lower this to about 12, just to be on the conservative side. The operating profit margins will probably go down, and I'm willing to lower that to about 27. I'm willing to lower it to 27. Tax rate will probably stay the same if they keep cash and securities overseas. And the current stock price we'll put in here is 96.34. Now let's examine the shares outstanding here, and they list 940 million, but as we had seen on the previous window, the shares outstanding were listed at 5.54 billion. So that's the number I'm going to use, 5.54 billion. So since that's in million, you take away the 6 zeros. 1, 2, 3, 4, 5, 6. 5.54 billion. And recalculate. Now we get an interesting intrinsic value of $177.21, which is more believable. Now, if we really want to be a little bit more conservative, let's assume that in the next 10 years, the growth rate would drop down to the 10% range. And let's just say the profit margins were to drop down to about 23%. Let's see what the stock price or the intrinsic value would be then. This drops us to 129.43, which is a believable number. So I'm going to go with that, 129.43, and let's see what kind of bargain we'd be getting. So in here, in the calculator or the estimator, we'd put in the price here at 96.65 and the estimated intrinsic at 129. Let's just make this 97 and see what it would be. 97 versus 129. What kind of bargain would we be getting? We would be getting about a 24.81 or almost a 25% bargain at this current price of 97. Now, other things that we should do is we should also take a look at the competitive advantages, and we can use this button to do a search and read about different perceived competitive advantages, such as its culture and technology and cost advantages. And here's an interesting article about why Apple's supply chain is ranked #1 in the world. So you have to take those into consideration and make a subjective judgment on whether those are sustainable. You can also hit this button and do a management analysis by looking at management's performance and also their executive compensation. So if we click on here, let's see how much they're paying their top managers. Now, according to this, total executive compensation is in the neighborhood of $136 million in 2015, which is a 21.7% decrease from the previous year. This will also give you a listing of who the key executives are in the company. And finally, we go back to the margin of safety estimate. And this time we can do an estimation of fair value or intrinsic value using the Guru Focus model. And let's see what they get. With a current price at 96.15, and they are using a 20% growth rate over the next 10 years with a terminal growth rate of 4. in their model, they get a larger number of fair value at 268, even without adding in the tangible book value. If you add in the tangible book value, that figure becomes 289. So in both models, we can see that Apple appears to be trading at a bargain. Now we can impose a greater limit on ourselves and say that the growth rate was to slow and go down to 15. Let's see what kind of figure we would get. Then we would get the 214. If we eliminate the addition of book value, we're getting about 192, which is still a very good bargain. Let's assume that in the next 10 years the growth rate would drop down to the 10% range. And let's just say the profit margins were to drop down to about 23%. Let's see what the stock price or the intrinsic value would be then. This drops us to 129.43, which is a believable number. So I'm going to go with that, 129.43. And let's see what kind of bargain we'd be getting. 7 versus 129. What kind of bargain would we be getting? We would be getting about a 24.81 or almost a 25% bargain at this current price of 97. So that's just a quick look at Apple, and as always, one should always look at the 4 filters: the understanding of the company and its products. Does it have a competitive advantage that is sustainable? Finally, does it have able and trustworthy managers? And then the 4th filter is estimating the intrinsic value or the fair value of a share of stock. They have also talked about buying back some of their shares, so that have an impact on the intrinsic value going forward. So these are warning signs that there may be a slowdown in the business. However, if you feel that the assumptions used on the intrinsic value estimation are fair, then there could still be some money to be made in Apple stock. And that is the end of this short and quick analysis of Apple.